Why do central banks buy record amounts of gold in an environment of tightening credit conditions and an environment of tightening of monetary policy? Fundamentally because they need an uncorrelated asset in their balance sheet that allows them to strengthen their reserves in an environment of currency debasement. And what we are seeing globally is precisely that. Currency debasement at a massive level. Inflation is eating away the purchasing power of most currencies, not just the developed economies, but certainly more in the emerging economies. And central banks need to purchase more gold because without it, the level of reserves that many of these central banks have are going to come down very quickly. And more importantly, many central banks are already in losses after the massive monetary injections of 2020 and 2021. And those losses need to be covered. Those will be covered with taxes and certainly with a change in the landscape of the balance sheet and the assets within it. Global markets have gone from oversold to overbought quite rapidly just because of a piece of data of inflation in the United States that wasn't particularly good. It was simply slightly better than was initially expected. Why do markets go so quickly from oversold to overbought, particularly in the European Union? If we look at the European stocks, the reality is that most of those stocks have not delivered particularly good earnings, and certainly the macro environment, both in the European Union, but also in the markets where they export, which are mostly Latin America and China, the weakness is pretty evident. So earnings downgrades are likely to continue. The overbought moment comes fundamentally from a perception that central banks, and particularly the European Central Bank, are going to become dovish very, very quickly. This collides with what the Federal Reserve is saying, but it certainly collides with the reality of what the ECB needs to do in order to curb inflation. So the bet of multiple expansion can be very dangerous, particularly when investors look at an opportunity based not on improving earnings, certainly not on improving macroeconomic conditions or credit conditions, but only on central bank action. Expecting rate cuts and quantitative easing is very dangerous, and a lot of people are starting to think about that. The European energy sector has massively outperformed the oil price for the first time in quite a prolonged period of time. And what we need to understand is that the likelihood of significant earnings downgrades is added to the weakness of the commodity. And the weakness of oil is coming from the massive slowdown of China and also from the weakening of the global industrial sector. Trade growth is expected to be subdued in 2023. And this obviously generates a significant pullback on energy prices. The Chinese slowdown is not going to last forever, but we cannot bet on oil prices recovering simply on the thought that the global economy is going to strengthen in 2023, because that is not something that is likely to happen. We are expecting bigger cuts in demand growth from OPEC and from the EIA, and certainly what we're likely to see is a very weak environment short term before the reality of underinvestment kicks in. So the trade of betting on energy at any cost can be dangerous, at least in the short term. The European economy is not just weakening because of the Ukraine crisis. It is weakening because of a very uncompetitive energy policy. The energy policy of the European Union has led the continent to a very weak position, both in security of supply, but also in terms of competitiveness, because even in periods when gas prices and oil prices come down, energy prices for consumers go up because of the massive burden of regulatory costs and taxes in household bills, which elevate the bill of a consumer to almost 60 to 70% in some cases of the total bill coming from taxes and regulated costs. The fact that the European Union at the same time is banning the development of natural gas, of lithium, of those essential raw materials, commodities that are needed for renewables and for energy security of supply certainly doesn't help. No? So we need to pay attention to a weakening economic environment that comes from a misguided energy policy. Food prices globally are improving a little bit, but let's remember that food prices were already elevated and reaching all-time highs in 2019 before the Ukraine war. So this improvement in food prices is meeting at the same time some very questionable decisions. In the European Union, many farms are being closed down in order to meet the European Union requirements of nitrogen emissions. And what that does is to leave the security of supply of grain and certainly of the food supply of the European Union in a much weaker state for the future. We need to understand that a lot of the food problems globally have been caused by excessive regulation that have led to a weakening of the amount of land available to farm. So that's something that to really ponder in an environment in which the security in terms of availability of food is something that everybody should be thinking about, not reducing land for farming. Banks are tightening credit conditions, but credit conditions remain extremely accommodative and certainly very solid. There is very little, at least in the latest data, information that shows that we are seeing a significant credit crunch. Why? Because interest rates remain negative in real terms. Second, because central banks continue to be accommodative also in terms of liquidity injections. So all of that is helping. The banking sector is better equipped and better capitalized than in the 2008 crisis, but we cannot just think about this as nothing is going to happen, because the risk of reducing core capital remains, and the increase in non-performing loans is likely to be evident in 2023 and 2024. Those may not be as aggressive as those of 2008, but we need to pay attention to what is happening in the banking sector and the financial sector so that we monitor the risk of a tightening of credit conditions that may lead to a credit crunch, which is not evident at the moment, but with the path of rate hikes and the weakening of global economies added to the reduction in valuations and the price cuts that we see in some of the assets in the balance sheet of banks, all of those can generate some level of risk. We need to monitor that environment. It is not evident now, but the risk is there.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.